Good morning, ladies and gentlemen, and welcome to the show on this Wednesday, the very 1st of September, 2021. Thank you for tuning in. Glad to have you guys here. Now, you know what? The economy's starting to slow down. Last night, I was working on charts, for about 3 hours. And I went over an awful lot of charts, and the data coming in that I'm receiving is that all of that stimulus that they did and all the stimulus measures, it was like pouring gasoline in, but now it's all burned off. A lot of it's burned off, and now the economy's starting to peak and it's starting to level off, it's starting to come back down. Let's get the chart started right here. Futures rise toward fresh record high as the PMIs confirm the global economy is slowing down. So we got a slow, stagnating, this economy is just now starting to stagnate. We've reached the peak of all that money they poured in. The economy's starting to stagnate, so we got a stagnating economy. And at the same time, we've got consumer price inflation. So when you put those two together, inflation and stagnating economy, you got something called stagflation. It's a classic definition of stagflation. We've just moved into stagflation. That's what we've got. I'm going to tell you, some of these economists out there, Peter Schiff predicted this was coming way in advance. A lot of my predictions have been so far in advance, guys, and they're starting to come true in spades. Well, you got to listen to what Peter Schiff had to say with his next prediction, is that we're going to have a sovereign dollar crisis. That's what's going to come next, and I'm right on with him. I'm right on with that prediction, too. We got a dollar crisis coming up. It's going to be a crisis which affects the value of what you can purchase with your dollars. This is so important right now that you pay attention to these things. As we've got the global economy slowing down, it's going to trigger. This is going to trigger waves in the economy where you've got the economy is starting to deflate. At the same time, they're going to have to keep all these bubbles propped up. They can't let them fall. And because they want to fall and they want to fall fast. Bubbles, when they pop, they want to pop really fast. You got to keep things propped up. And this is not a situation where the Fed can say, well, we'll let them fall some, because they're not going to fall some. They're going to fall everything. You got to keep it popped up. And in order to do so, you got to put enough money into the system where you're not only going to cause this stagflation, eventually they are going to cause hyperinflation. Got to protect yourself more so than ever with gold and silver. Let's take a look at the silver price today. $24.15. It's up 27 cents on the day. Gold is not really following that much. Let's take a look at gold. The gold price is at $18.10, and it hasn't went anywhere. In fact, it went down $3.20. Haven't checked into it. There might be something going on in the silver market today. What we've been seeing happening in the silver market in the last week or so, or the last couple weeks, is we see bigger orders coming in for these silver retailers. And they're worried. I've heard some of the silver retailers out there talking. And they're worried. They're worried that in the very near future, that the big money, really big money, might start sending orders in where they're caught in a conundrum. If you're a retail silver dealer, you're caught in a conundrum where this order comes in, and it's like no order you've ever seen before. And do you fill it? What do you do? Because it might be like an order that's in the millions, not your typical order. Do you fill it? And what kind of constraint would that put on the physical silver supply if you fill it? There's going to be orders like that coming in the very near future. Well, I strongly suspect, because the order sizes, some of them are increasing now. In other words, we've been seeing small fish feeding on physical silver. And the reason for this is allocation. For the big money out there, it's difficult. Allocation is a very difficult thing for the big money because it's like you've got to have a warehouse and you've got to have guards and everything else. And they're used to buying in the equity market and things like that where you just push a mouse, boom, it's easy, it's one off, it's one and done, right? But buying physical silver, actual physical silver, not futures, but physical silver is difficult for them. And so they have been avoiding it, the big fish and the really big fish. So there's medium-sized fish and there's really big fish. And the small fish have been coming in and feeding off it. And they only buy like maybe 50, 100 ounces, 200 ounces, maybe 1,000 ounces, but nothing big. Because they tend to take allocation. They tend to allocate it. They take it with them. In other words, they buy it and take it with them. Where the big fish, if they're going to buy millions of dollars worth, that creates that conundrum I told you about. Well, we've seen the first big fish come in for gold there about a week ago. Was it $100 million worth of gold or something? Some huge, I can't remember what it was. Was it 50 million or 100 million? Anyway, it was a big allocation. It was like 100 gold bars. That's a lot. And so, but that might be a signal for more coming, a lot more coming down the road now that everything's shifting. They want to know where to park their money. You can't park it in bonds anymore. You've got negative yields coming, and it's so low right now it doesn't make any sense in stagflation. Uh, and the equity market's peaking and everything else. So the places to park money are being narrowed down, and precious metals now are suddenly starting to look really good. But there's the allocation problem. Well, they will solve eventually. The big money out there will solve the allocation problems, and they might come in and start coming in to feed. And if they do, they're going to break these markets. It's as simple as that. And what I mean by break a market, if you break the silver market, that means there's no physical supply available for anybody. In other words, they've gobbled it all up, and the silver market is broken. So what would happen if the silver market breaks? Let's just talk about this for a minute. And they've bought up all of the physical supply. There's none left. Well, they cannot. The world's central banks right now cannot let the gold and silver price become unhinged to the upside. It would break the world's financial system. Just like if they let the bonds go up. They can't let the bonds go up either. The bond yields. That would break the system too. It's a very fragile system we have now. So what they'll have to do is the silver dealers and stuff out there will just jack up the premiums. Now, they can let the silver price move and gold price move a little bit. They can probably, I'm just going to have to estimate this for you guys because how much they can let it go up. They can probably let the gold price, without breaking the system, they can probably let it go up somewhere around maybe $2,300, $2,400 for gold. And they could probably let the silver price drift up to about 35 or 40 bucks on the spot price. But that's the limit where they can let it go. They can't let it go too much higher than that without breaking the system. But the gold premium price and the silver premium price could explode. In other words, what you might be looking at, you still might be looking at like a $30 silver price on the spot price, but with like $100 premium or something like that, or more, if the silver market breaks. And also, for you guys out there who've been wondering about, you take your silver into a silver dealer and they're like wishy-washy about whether they want to buy it or not. They're like, you slide it on the counter and they look at it and they're like, oh, we'll give you $2 under spot or whatever because they don't really want it. That'll all change. If they break the silver market and all the silver's gone, these silver retailers out there are just going to be like trying to allocate silver anywhere they can to keep their business open. That wouldn't last very long, I mean, what would happen is the prices would explode to the upside, like I say, and your premiums would go up so high that there's new fresh supply that would probably come in to the market from people selling to them, into the market. Probably start to see sales coming back into the market. So it probably wouldn't last long, but I'll tell you, premiums could go so high it could be unbelievable. I'm thinking I might be underestimating it, like when I say $100 premium per ounce on silver. It might go an awful lot higher than that because the market's broken. Silver would come back in from people who hold silver, strong hands who hold silver would start to sell back in, and they would probably have to supply a lot of these silver retailers to keep them in business, but they would be paying them part of that premium. In other words, so you would get your money. If the silver price explodes to the upside and we see the spot price stay down low, the people that sell back in would probably get a good chunk of that premium. And the silver dealers out there, retail dealers, would be very happy to get the silver. Very happy indeed because it keeps them in business. And then they turn right around and they sell it for even a higher dollar, to the people who are just choking to get it and putting in these big orders and stuff. So that's what could happen. I'm just kind of giving you guys a little eyesight into what might happen in this market in the very near future. It could happen because I know that they must be running on vapors right now, trying to allocate gold and silver for this market, real gold and silver. Where they keep the spot price, they keep playing these games with the spot price, that's been going on for ages, and it's just disgusting. It makes you sick, the games they play with these spot prices. Let's take a look now at cryptocurrencies today. 21.29 means crypto's moving up quite nicely right now. Now, the Bitcoin price isn't moving up that much. It's at 47,519. That means a lot of money is pouring into these altcoins. What that means is it means very healthy. It means that the crypto market is very healthy right now because the altcoins are getting the highest amount they're absorbing the highest amount of liquidity into these altcoins, So you see your favorite altcoins going up. Yeah, that's what's going on in the crypto. This is a good, healthy, bullish trend, in cryptos. Let's take a look now at the Dow Jones Industrial Average, and it's down 41 points on the day. It's like I say, I mean, equities right now, they kind of peaked. For now, they've peaked. But we're moving into a hyperinflation, and the sky's the limit for equities in the stock market. The sky is the limit because in a hyperinflation, you see that typically, it's very typical for the stock market or the equity market to hyperinflate as well from all of the liquidity in the system. It doesn't mean you're doing good with your because it's all priced in the fiat. It's going downhill, and so could see what they refer to as a melt up in the markets when the dollar starts to go down. But that hasn't happened yet. The dollar is not hyperinflating yet. Right now, what we're in is what's called the acceleration phase that leads to a hyperinflation. It's early stages yet. It's not actual hyperinflation. Okay, guys, let's take a look at our oil price today. It's 67.30. It's down. It's down $1.20, which is a big drop in oil. And now let's take a look at our move index, 59.54. And it looks like it's dropping today a little bit. It's down into the 50s, but move index hasn't been moving a lot lately. It's been staying pretty stable. Let's take a look at our bonds and rates today. We're seeing a mixed bag today. Seeing a long end falling, the middle kind of going up a little bit. There's not a lot of movement in the bond yields today. We're looking at 1.3 on the US 10-year and 1.92 on the 30-year. And now let's finish off with the US dollar index at 92.45, and the dollar's fallen today. Stagflation, that's where we are, guys. And that is a very hard scenario on the people. Why? Is because the economy is stagnant. You're not going to make a lot of money in a stagnant economy. But prices are going up daily on everything that you have to purchase. So it squeezes you. That's what stagflation does. Very, very, very nasty stagflation is. But what's even nastier is when the hyperinflation comes. It's nastier than stagflation because it really puts the squeeze on the people. Not on so much on the billionaires and stuff, but on the people. And the people are already been through a lot. And, when the hyperinflation hits, it's going to have an impact, a tremendous impact. And maybe I'll do a show and talk about the actual impact of the hyperinflation and what I expect. I'll tell you how big the impact of hyperinflation can be. A fast-moving hyperinflation. One that really takes the dollar down. We just had a hurricane called Ida, IDA. Came through and hit Louisiana. Picture if there's 100 IDAs that came and hit the United States of America and created areas in the United States where it would be patchy. One area you go and the power would still be on, another area the power would be out. That's what hyperinflation can do. It can take down areas, and these areas are the areas that already have trouble, but it can take down large areas of a country, and in that impact, it impacts the whole country, but not evenly. It's because of the reaction of the people to the hyperinflation. We've seen the same thing happen in Venezuela. Certain areas where the people, because of the problems created, because of squeezing them, and they don't have enough money to buy food, and they're hungry and everything else, a tremendous rage. I'll call it rage. Just like that rock band, Rage Against the Machine. The machine being the system. Tremendous rage comes in, especially when they can't feed themselves. We saw a little taste of this back during the COVID crisis, originally during the COVID crisis, when American cities were burning. That was rage that caused that. But that might have been like a rage factor of, say, 3 or 4. Hyperinflation can slide that bar up on the rage factor up to like a 10. And so you can have areas of the system fail. And the areas that are kept up are the better supported areas, the areas that are able to come through it better, So you get and this is a worldwide. I'm not just talking about the United States of America and what it can do to the United States. It'll do this to every country on earth. And so, because this is a worldwide hyperinflation, and of course this is unprecedented because we've never had a worldwide hyperinflation before, where all the currencies are going down together in their purchasing power, its impact would be tremendous. Not on the level of what I would call it SHTF. Not on that level of impact. That's the level of impact that puts the world into a Mad Max world. I don't believe it would go that far. But on the other side of that, it certainly wouldn't be anything to take lightly either. It would be pretty bad too, you know. The Germans can tell you, if you study your history books, the hyperinflation that they went through during the Weimar Republic was no picnic, I'll tell you. They would do anything to avoid that. Germany's socking the gold away right now. You know. Thank you guys for listening to my show. Like and subscribe, and we'll catch you guys in the very next episode. Bye-bye.